alive, oh, we're alive. For the first time. Uh, we're going to be live for, let's say, 3 hours. 3 hours. So by 3 o'clock, I'm going to go and sleep. I have like 6 long form videos to watch. Then I'm studying for something, sure. Looking for knowledge.
Of probabilities. Since he was writing about finance, the physics community didn't take any notice, but the mathematics of the random walk would go on to solve an almost century-old mystery in physics. It's like a do not disturb setting for your mind. It gets you focused in just 5 minutes, using science. In 1827, Scottish botanist Robert Brown was looking at pollen grains under the microscope, and he noticed that the particles suspended in water on the microscope slide were moving around randomly. Because he didn't know whether it was something to do with the pollen being living material, he tested non-organic particles, such as dust from lava and meteorite rock. Again, he saw them moving around in the same way. So Brown discovered that any particles, if they were small enough, exhibited this random movement, which came to be known as Brownian motion. But what caused it remained a mystery. 80 years later, in 1905, Einstein figured out the answer. Over the previous couple hundred years, the idea that gases and liquids were made up of molecules became more and more popular. But not everyone was convinced that molecules were real in a physical sense, just that the theory explained a lot of observations. The idea led Einstein to hypothesize that Brownian motion is caused by the trillions of molecules hitting the particle from every direction every instant. Occasionally, more will hit from one side than the other, and the particle will momentarily jump. To derive the mathematics, Einstein supposed that, as an observer, we can't see or predict these collisions with any certainty. So at any time, we have to assume that the particle is just as likely to move in one direction as another. So, just like stock prices, microscopic particles move like a ball falling down a Galton board. The expected location of a particle is described by a normal distribution which broadens with time. It's why even in completely still water, microscopic particles spread out. This is diffusion. By solving the Brownian motion mystery, Einstein had found definitive evidence that atoms and molecules exist. Of course, he had no idea that Bechellier had uncovered the random walk 5 years earlier. By the time Bechellier finished his PhD, he had finally figured out a mathematical way to price an option. Remember that with a call option, if the future price of a stock is less than the strike price, then you lose the premium paid for the option. But if the stock price is greater than the strike price, you pocket that difference, and you make a net profit if the stock has gone up by more than you paid for the option. So the probability that an option buyer makes a profit is the probability that the price increases by more than the price paid for it, which is the green shaded area. And the probability that the seller makes money is just the probability that the price stays low enough that the buyer doesn't earn more than they paid for it. This is the red shaded area. Multiplying the profit or loss by the probability of each outcome, Bechellier calculated the expected return of an option. Now, how much should it cost? If the price of an option is too high, no one will want to buy it. Conversely, if the price is too low, everyone will want to buy it. Bechellier argued that the fair price is what makes the expected return for buyers and sellers equal. Both parties should stand to gain or lose the same amount. That was Bechelier's insight into how to accurately price an option. When Bechellier finished his thesis, he had beaten Einstein to inventing the random walk and solved the problem that had eluded options traders for hundreds of years. But no one noticed. The physicists were uninterested, and traders weren't ready. The key thing missing was a way to make a ton of money. In the 1950s, a young physics graduate, Ed Thorpe, was doing his PhD in Los Angeles. But a few hours' drive away, Las Vegas was quickly becoming the gambling capital of the world, and Thorpe saw a way to make a fortune. He headed to Vegas and sat down at the blackjack table. Back then, the dealer only used a single deck of cards, so Thorpe could keep a mental note of all the cards that had been played as he saw them. This allowed him to work out if he had an advantage. He would bet a bigger portion of his funds when the odds were in his favor and less when they weren't. He had invented card counting. This is a remarkable innovation considering blackjack had been around in various forms for hundreds of years. And for a while, this made him a lot of money. But the casinos got wise to his strategy and they added more decks of cards to the game to reduce the benefit of card counting. So Thorpe took his winnings to what he called the biggest casino on Earth, the stock market. He started a hedge fund that would go on to make a 20% return every year for 20 years, the best performance ever seen at that time. And he did it by transferring the skills he honed at the blackjack table to the stock market. Thorpe pioneered a type of hedging, a way to protect against losses with balancing or compensating transactions.
Thorpe did it mathematically. He looked at the odds of winning and losing and decided that under certain conditions, you can actually tilt the odds in your favor by using certain patterns to be able to make bets.
Suppose Bob sells Alice a call option on a stock, and let's say the stock has gone up, so now it's in the money for Alice. Well, now for every additional $1 the stock price goes up, Bob will lose $1. But he can eliminate this risk by owning 1 unit of stock.
Go
And
hard,
if the price
go
goes
hard.
up, he would lose $1 from the option, but gain that dollar back from the stock. And if the stock drops back out of the money for Alice, he sells the stock so he doesn't risk losing any money from that either. This is called dynamic hedging. It means Bob can make a profit with minimal risk from fluctuating stock prices. A hedged portfolio pi at any one time will offset the option V with some amount of stock delta.
It basically means I can sell you something without having to take the opposite side of the trade. And the way to think about it is I have synthetically manufactured an option for you. I've created it out of nothing by doing dynamic trading, dynamic hedging.
As we saw with Bob's example, delta, the amount of stock he has to hold, changes.
When you hold it from Bob, you want Babylon.
Withdrew and receiving input. Hi, my name is Dawn Lund. I'm a global social media strategist.
Depending on current prices. Mathematically, it represents how much the current option price changes with a change in the stock price. But Thorpe wasn't satisfied with Bichelier's model for pricing options. I mean, for one thing, stock prices aren't entirely random. They can increase over time if the business is doing well, or fall if it isn't. Bichelier's model ignored this, so Thorpe came up with a more accurate model for pricing options, which took this drift into account.
I actually figured out what this model was back in the middle of 1967, and I decided that I would just use it for myself, and then later I kept it quiet for my own investors. The idea was to basically make a lot of money out of it for everybody.
His strategy was, if the option was going cheap according to his model, buy it. If it was overvalued, short sell it, that is, bet against it. And that way, more often than not, he would end up on the winning side of the trade. This lasted until 1973. In that year, Fisher Black and Myron Scholes came up with an equation that changed the industry. Robert Merton independently published his own version, which was based on the mathematics of stochastic calculus, so he is also credited.
I thought I'd have the field to myself, but unfortunately, Fisher Black and Myron Scholes published the idea, and they did a better job of the model than I did because they had very tight mathematics behind their derivation.
Like Bichellier, they thought that option prices should offer a fair bet to both buyers and sellers, but their approach was totally new. They said, if it was possible to construct a risk-free portfolio of options and stocks just like Thorpe was doing with his delta hedging, then in an efficient market, a fair market, this portfolio should return nothing more than the risk-free rate, what the same money would earn if invested in the safest asset, U.S. Treasury bonds. The assumption was that if you're not taking on any additional risk, then it shouldn't be possible to receive any extra returns. To describe how stock prices change over time, Black, Scholes, and Merton used an improved version of Bichelier's model, just like Thorpe. This says that at any time we expect the stock price to move randomly, plus a general trend up or down, the drift. By combining these two equations, Black, Scholes, and Merton came up with the most famous equation in finance. It relates the price of any kind of contract to any asset, stocks, bonds, you name it. The same year they published this equation, the Chicago Board Options Exchange was founded. Why is that equation so important? Like for finance, how did that change the game?
Well, because when you solve that partial differential equation, you get an explicit formula for the price of the option as a function of a bunch of these input parameters. And for the very first time, you now have an explicit expression where you plug in the parameters and out pops this number so that people can actually use it to trade on.
This led to one of the fastest adoptions by industry of an academic idea in all of the social sciences.
Within just a couple of years, the Black-Scholes formula was adopted as the benchmark for Wall Street for trading options. The exchange-traded options market has exploded, and it's now a multi-trillion-dollar industry. The volume in this market has been doubling roughly every 5 years. So this is the financial equivalent of Moore's Law. There are other businesses that have grown just as quickly, like credit default swaps market, the OTC derivatives market, the securitized debt market. All of these are multi-trillion-dollar industries that in one form or another make use of the idea of Black-Scholes-Merton option pricing.
This opened up a whole new way to hedge against anything, and not just for hedge funds. Nowadays, pretty much every large company, governments, and even individual investors use options to hedge against their own specific risks. Suppose you're running an airline and you're worried that an increase in oil prices would eat into your profits. Well, using the Black-Scholes-Merton equation, there's a way to accurately and efficiently hedge that risk. You price an option to buy something that tracks the price of oil, and that option will pay off if oil prices go up. And that will help compensate you for the higher cost of fuel you have to pay. So Black-Scholes-Merton can help reduce risk, but it can also provide leverage.
An ongoing battle between bullish day traders and hedge fund short sellers that have bet against the stock, GameStop shares, have now risen some 700%.
Well, GameStop is a really interesting example for all sorts of reasons, but options figure prominently in that example because a small cadre of users on this Reddit sub-channel, Wall Street Bets, decided that the hedge fund managers that were shorting the stock and betting that the company would go out of business needed to be punished, and so they bought shares of GameStop stock to try to drive up the price. Turns out that buying the stock was not enough because with $1 worth of cash, you can buy $1 worth of stock. But with $1 worth of cash, you can buy options that affected many more than $1 worth of stock. Perhaps in some cases, $10 or $20 worth of stock for $1 worth of options. And so there's natural leverage embedded in these securities. And so the combination of buying both the stock and the options caused the prices to rise very quickly. And what that did was to cause these hedge fund managers to lose a lot of money quickly.
How big is this market for derivatives? How big is this whole area that kind of comes out of Black-Scholes market?
There are estimates of how large derivatives markets are. And first, let's be clear what a derivative is. A derivative is a financial security whose value derives from another financial security. So an option is an example of a derivative. In general, the size of derivative markets globally is on the order of several $100 trillion.
How does that compare to the size of the underlying securities they're based on?
It's multiples of the underlying securities.
I just have to interrupt because it seems kind of crazy that you have more money riding on the things that are based on the thing than the thing itself.
That's right.
So tell me how that makes any sense.
Because what options allow you to do is to take the underlying thing and turn it into 5, 10, 20, 50 things. So these pieces of paper that we call options and derivatives, they basically allow us to create many, many different versions of the underlying asset.
If you want to learn how to edit really well from professional Hollywood editors,
I know how to edit now. What's in the salt?
I'm talking about real creative
asset. Versions that individuals find more palatable because
I
of
gotta
their own
sleep.
risk-reward preferences.
Does this make the markets and the global economy more stable or less stable or no effect?
All three. So it turns out that during normal times, these markets are a very significant source of liquidity and therefore stability. During abnormal times, by that I mean when there are periods of market stress, all of these securities can go in one direction, typically down. And when they go down together, that creates a really big market crash. So in those circumstances, derivatives markets can exacerbate these kinds of market dislocations.
In 1997, Merton and Scholes were awarded the Nobel Prize in Economics. Black was acknowledged for his contributions, but unfortunately he had passed away just 2 years earlier.
We're going to make a lot of money in options, but now Black and Scholes have told everybody what the secret is.
With the option pricing formula now out for everyone to see, hedge funds would need to discover better ways to find market inefficiencies. Enter Jim Simons. Before Simons had any exposure to the stock market, he was a mathematician. His work on Riemann geometry was instrumental in many areas of mathematics and physics, including knot theory, quantum field theory, and quantum computing. Chern-Simons theory laid the mathematical foundation for string theory. In 1976, the American Mathematical Society presented him with the Oswald Veblen Prize in Geometry. But at the top of his academic career, Simons went looking for a new challenge. When he founded Renaissance Technologies in 1978, his strategy was to use machine learning to find patterns in the stock market. Patterns provide opportunities to make money.
The real thing was to gather a tremendous amount of data, and we had to get it by hand in the early days. We went down to the Federal Reserve and copied interest rate histories and stuff like that because it didn't exist on computers.
His rationale was that the market is far too complex for anyone to be able to make predictions with certainty. But Simons had worked for the U.S. Institute for Defense Analysis during the Cold War, breaking Russian codes by extracting patterns from masses of data. Simons was convinced that a similar approach could beat the market. He then used his academic contacts to hire a bunch of the best scientists he could find.
What was your employment criteria then? If they knew nothing about finance, what were you looking for?
Someone with a PhD in physics and who had 5 years out and had written a few good papers and was obviously a smart guy, or in astronomy, or in mathematics, or in statistics. someone who had done science and done it well.
It's not surprising that mathematicians and physicists are involved in this field. First of all, finance pays a lot better than being an assistant professor in mathematics. And for a number of mathematicians, the beauty of option pricing is equally compelling to anything else that they're doing in their professions.
One of these was Leonard Baum, a pioneer of hidden Markov models. Just as Einstein realized that although we can't directly observe atoms, we can infer their existence through their effect on pollen grains, hidden Markov models aim to find factors that are not directly observable, but do have an effect on what we can observe. And soon after that, Renaissance launched their now famous Medallion Fund. Using hidden Markov models and other data-driven strategies, the Medallion Fund became the highest returning investment fund of all time. This led Brad
Doctors, nurses and engineers who have ever dreamed of living in Australia now have an opportunity if they have the qualifications and experience. Australia is well known for beautiful beaches, safety and high standards of free public health care and education, making it one of the most desired places to live and create a new life. In order to be eligible,
most traders believe that finding an edge is the finish line of trading. It's not. Finding an edge is where the real game actually begins. A fake edge can look real. A real edge can look fake. A real edge can disappear. And even a real edge can destroy you if you don't understand the path required to trade it. This is the part of trading mathematics that almost nobody talks about. Everybody's concerned about finding an edge, but no one talks about what happens after you do. This video talks about both. It's not enough to ask if you have an edge. You have to ask 3 harder questions. How is the edge created? How do I know it's real? And what must happen for that edge to survive long enough to be realized meaningfully? That's why in this video, we're going to break down edge mathematics into 3 stages: creation, detection, and realization. Creation explains the mathematical nature of an edge. Detection explains why proving that an edge is real is much harder than most traders believe. Realization explains what happens after the edge exists when variance, randomness, drawdowns, position sizing, compounding, and trader behavior decide whether the edge actually survives long enough to be fully exploited. Let's begin with the edge creation. There are 2 mathematical levers in the creation of an edge: the win rate and the payoff ratio. The win rate is of course how often you win in percentage terms. The payoff ratio is the ratio between your average winning trade and your average losing trade. Notice that payoff ratio is not the same as risk-reward ratio. Risk-reward ratio is what you plan to happen in each individual trade. Payoff ratio is the average of what actually happens across many trades. Another way of looking at this is that risk-reward ratio is an input and a strategy design decision. The payoff ratio is an output and a measure of execution quality. For example, let's say you plan to get 1 to 3 risk-reward ratio in each trade, but your payoff ratio across many trades is 2, which means you risk $1 to actually make $2 on average in each trade. This gap between the $3 of profit you aimed for and the $2 of profit you actually got is called edge leak, and it's one measure of execution quality. The reason this happens and how to fix it is a subject for another video. The other mathematical lever is the win rate. Beginners fall for the trap of thinking the higher win rates are better, but that's not true at all. You can make money with a low win rate and lose money with a high win rate. What really matters is the win rate relative to the break-even win rate provided by your payoff ratio. The formula for knowing the break-even win rate is simple: 1 divided by 1 plus b, which is the payoff ratio. In this table, you can see the various break-even win rates associated with each payoff ratio. For example, if you risk $100 to make $300 in each trade on average, your payoff ratio would be 3, and your break-even win rate will be 25%. The next step here is to plot what is called the break-even frontier. graph is very useful to visualize the mechanics of edge creation, as you're about to see. Any strategy you can imagine is a coordinate on this graph, and the location of the coordinate determines whether the strategy is profitable or not. Strategies above the line are profitable, at the line they break even, and below the line are unprofitable. So a good strategy is not related to the win rate or the ratio you have. It relates to whether the strategy sits above, at, or below the break-even frontier. Some traders already understand that win rate is meaningless by itself, but they also seem to think that a good ratio automatically creates an edge. It doesn't. It just changes the break-even baseline you have to overcome. For example, let's say you have a strategy with 80% win rate at 0.5 payoff ratio. This strategy will be profitable. If your win rate drops to 60%, the strategy will go below the break-even frontier, and it will become unprofitable with the same payoff ratio. In the same way, let's assume you have a payoff ratio of 4, which many traders assume to automatically create an edge, but your win rate is only 15%. The strategy will be below the break-even frontier, and it will be unprofitable. Only when it goes above the break-even frontier will it become profitable. This leads us to a more subtle point. If you open many random trades using a specific risk-reward ratio, you'll find that the win rate converges to the break-even frontier. For example, if a random strategy has a very low ratio such as 0.1, it will naturally produce a high win rate for a simple reason. The target is much closer to the entry than the stop. In other words, a high win rate does not mean you are skilled, in the same way that a low win rate doesn't mean you are not skilled. The fact that win rate converges to the break-even rate in a random strategy means that risk-reward ratio by itself does not create an edge. This leads us to the important decision of choosing the optimal ratio. The pitfall here is that this sounds like a mathematical question because we're talking about percentages and ratios, but here's the key. The answer to many trading questions sits at the intersection between multiple fields. The optimal risk-reward ratio is simultaneously a mathematical, technical, and behavioral question. We already saw the mathematics. In terms of technique, the optimal ratio depends on the type of strategy you trade. For example, mean reverting strategies work better with lower ratios, and consequently higher win rates. If you aim for higher ratios in that type of strategy, you create unnecessary losing streaks and can make profits unnecessarily. Trend following strategies, however, work better with the higher ratios and consequently lower win rates. If you aim for a low ratio in that type of strategy, you leave precious gains on the table. The infrequent large profits are what creates an edge in that setting. The bottom line is, different kinds of strategies ask for different ratios. The third part of the answer of what is the optimal risk-reward ratio is behavioral. High ratio low win rate and low ratio high win rate produce very different psychological burdens on the trader, and you must be aware of which one you are more likely to endure. Let's imagine the extremes to make this point as clear as possible. An extremely low ratio creates the necessity of being right constantly, which will happen for a while, creating positive reinforcement and increasing confidence. And when the losing trade comes, the trader has to deal with a large loss that is financially and psychologically devastating. On the other hand, an extremely high ratio creates very long losing streaks, with occasionally profitable trades that compensate for it. The problem with that is that even though each losing trade in a losing streak is small, the repeatable failure slowly kills the trader's confidence in the strategy before the edge has time to emerge. So it's not only about the type of strategy and market scenario you want to exploit, but it's also about the type of psychological burden you want to endure. We're talking about the extremes here, which you should avoid, but how you gravitate the middle of this graph is dependent on these three dimensions: mathematics, technique, and behavior. If you prefer the pressure to be right more often rather than fighting to maintain confidence over losing streaks, you'll be better off with a mean reverting strategy. If you can tolerate longer losing streaks, knowing the edge will emerge eventually, you'll be better off with trend following. So the mathematics tells you how these variables work and what's possible. Your psychological preference determines the strategy type and consequently the optimal ratio for you. This finishes the part of edge creation. In summary, the two most important mathematical variables in edge creation are the win rate and the payoff ratio. The gap between risk-reward ratio and payoff ratio represents an edge leak. Risk-reward ratios don't automatically create an edge. They just change the baseline break-even level you must overcome. You can make money with a low win rate and lose money with a high win rate. The optimal risk-reward ratio is not just a mathematical question. It's also a technical and behavioral question simultaneously. Your psychological profile must determine the type of strategy you trade. The main point of this first part is that edge creation is not just about mathematics, it's also about technique and behavior simultaneously. That's why there is no universal best risk-reward ratio. You must be honest with yourself to find out what ratio fits your trading profile. That's the key. If you like the content so far, don't forget to click the like and subscribe if you haven't already. We move on now to the second part, which is edge detection.
I have a question for you. What would change in your life if next month you made an extra $11,000? Because that's exactly what happened to Zara, who's a mother of two who made an extra.
They don't come.
Objectively detecting
They don't
edge
come.
is done through the expectancy formula in mathematics, which combines the two main variables of an edge.
Afana.
Payoff ratio. For example, let's say you have a 35% win rate, which automatically translates to a 65% loss rate, with an average winner of $300 and an average loser of $100. This gives you an expectancy of $40. Expectancy is basically an average of what you can expect in each trade, given your win rate and payoff ratio, which are greatly impacted by risk-reward ratio as we saw previously. For your edge to exist, expectancy must be positive. If your expectancy is negative, there is no amount of discipline in the world that is going to make you profitable. With that said, when you're calculating your edge through the expectancy formula, there are two pitfalls. The first pitfall is related to sample size. If you are calculating your expectancy based on the last 10 trades, it's one thing. If you are calculating it based on the last 300, it's another thing entirely.
Oh, calm down. Breathe down the overload. Breathe. So right now, what this guy is talking about is win rate no be am. Win rate no be am. Money is a rich man's one. Money, yeah. Somebody say how. Money. Holy Ghost. Oh. One leg. Hopefully I'll be consistent. Hopefully. Because I'm not just meeting yourself. If anybody see this thing, come on my YouTube, You have to hammer me. If anybody watches this video and see that I'm not doing what I wanted to do, comment, please. Talk to me and how you like. I want to make it. Please, Biko, I want to make it in life. I want to be consistent in the It's one life. I have to keep it interesting for 3 hours. We'll get there. How do I keep my life? It should be very interesting. Somebody say how. Somebody say how. 3 hours. Somebody's life. It's not. It's not. This trading thing. Money. Shy moto. Let me just play some more music so that my head, I just clear my head some more. Come back refresh. If you don't listen to Anthony Tate,
is to never miss a day, because sometimes you get lucky, and you'll never miss a lucky day if you try every day. Because when you've come from the absolute bottom to the absolute top, you've done it all for coming back, and hard work and dedication, and never missing a day. One, because of compounding interest, and two, if you don't try every day, you might miss your lucky day. And that's what people don't understand. If you never miss a day and you never don't try and you're always on time, was I late today? No, on time, and you try and improve every aspect of your life, and you're a professional, and you try and make sure that you analyze your decisions, you give yourself feedback, you don't make mistakes, you're not lazy. If you try and you make it to the top, because you look at the people down below and you're like, well, why didn't you try? I did. Oh, I did too. No, you didn't. That's a lie. Now you're lying to me, and that annoys me. I believe that they have the lives they deserve because they haven't been prepared to suffer like I've suffered. If I was as lazy and incompetent as these people, I'd be like them. These people, they're not triers. I didn't even have chances that good. I wish I did. I wish I had a billionaire sitting on the internet explaining to me how the world worked. I would have done anything for that. But I've never had that chance. I had to work them all out myself, take huge monumental risks, do the nearly impossible to escape. It's easier to get rich now than it's ever been. This goes back into my mentality about the kind of person who takes risks and takes action. So then people will say to me, this is what's so amazing. People say to me, oh, how do you have all these big ideas? How do you have $100 million of cars? You're so lucky. It's not luck. It's never been luck. I've been the person who took action. And if I were to tell you right now what action to take, you won't do it. So I'm not going to feel sorry for you when you fail. I'm not gonna feel sorry for losers. My life is just work. But that's boring, right? But that's the truth about it. I'm on my laptop all day, every day. I have 18 hours a day of screen time. I'm either training or I'm working. Do I know some women? Yes, of course. Do I have some fancy cars to drive? Yes. Can I go to the auto restaurant? Yes. But the majority of the time, all I do is work because that's what I enjoy to do. I don't think most things outside of work are as entertaining as the work itself. That's why I'm successful. Yeah, I do have women who I know, and yeah, I can have that crazy lifestyle, and I did it for a while. But I wouldn't even say it's empty. You know, people get successful and they start to say, oh, I'm above that, it's empty, it's empty, it's vaporous. That's true. I just don't think it's as fun as working. I think just winning is fun. I think the whole point of life is a man is competition in the first place. Life is rented. I know exactly what you're saying, but I'm saying my philosophy is that you never own anything that you're not renting anyway. Your physical health is not something you have, it's something you rent. If you don't look after it, you lose it. Just like a house, if you don't pay the rent, you lose the house. It's the same with your business. If you don't look after your business, you lose the business, you lose your money. It's the same with women. If you don't look after the women, you lose the women. So do you have to sit there and attribute values to each thing and work out, is this worth the extra seconds in the day to maintain it? If I'm going to do anything, you're going to optimize it, right? Isn't that life? You go to the fight gym and you spar and you lose and you get better. You attempt to optimize it. You try and make some money, you attempt to optimize it. You attempt to grow the number of followers you have on your YouTube channel. When you go out dating women, you attempt to optimize it to get better at it. If I'm going to speak to people, I'm going to optimize it to be maximally effective. I want to be the person who can say less words than everybody else and have a larger impact. That's what I want to do. I've chosen that. I've decided to do that. I understand that to be able to do that, I also need to have a certain persona and a certain capability. It's hard to do that if I'm not financially successful. It's hard to do that if I'm physically weak. If I walk into a room and I want to bellow, and I want to sit and talk in a particular manner, but I'm physically weak and broke, nobody gives a shit. But I have real-world accolades. Also, a lot of my real-world accolades are based on the fact that I've suffered, and I'm prepared to go through difficult scenarios for the things I've said, which once again adds credence to my words. Does happiness exist to you? I don't think it's important. I am already happy, and I'm happy all the time, even when bad things happen. I'm always a happy person. I don't operate in the happy, sad paradigm. So to me, I'm always happy because I don't measure it. If you don't measure something, it doesn't exist. If you give attention to depression, you're depressed. If you give attention to how happy you are, you're always going to be measuring if you're happy or not that day. If you don't think about those things, they don't exist. I don't give measurement to them. Is that the heartbreak part is the best part. Yeah, that's the real love. The whole holding hands, everything's happy, we're out at dinner, smiling, laughing, no, that's boring. The true memory of love, the actual real fun part of the love is the part where you feel the deepest, and you feel the deepest when it goes wrong. And we can apply that to everything. That's the funnest part of life. Funnest part of life. It's never fun at the time, but in retrospect, when you want to use hindsight and analyze your entire life via the lens of your mind, when you go back in time, those bad times are the best times. Because I believe as a man, chasing happiness is probably the most asinine thing you can do. It's the easiest way to lose as a man is to chase happiness. What will make me happy is not how you win as a man. How you win as a man is I don't care how I feel, what must be done. And really the only thing that's fun in life is work. The only thing that's fun is the thing that made you rich in the first place. That's the reason it made you rich, because you found it fun. There are no fun activities to do once you're rich. The only thing you can really do is slow things down. So a poor person has a 1 hour lunch. I'm allowed a 4 hour lunch. Great. You can add some time to things. But I don't know. I see there are some other rich people who, they get enamored by wine. And they think that giving their life to tasting different grapes is somehow not a complete waste of consciousness. But they're dipshits. And that's why they're not important. And that's why no one knows who they are. So when I talk to other millionaires who are like, oh yeah, with wine, I like to spend my time wine. Well, then you go do that. Life is just, it's a game. We're living in a simulation. And if you want a high score, you have to choose the highest difficulty. So I want a high score. A lot of these people, especially people who talk about Zen, Stoicism, etc., I distrust. And this isn't specifically about him. This is about all of these people. Because they'll sit in a beautiful field with green grass in Bali. And they'll put on a stupid robe. And they'll sit there and they'll do this. And they'll say, I'm Zen, my mind is great. You're in a beautiful field in Bali. Of course you're Zen. What are you going to be upset about? It's sunny. It's not even raining. You have nothing to complain about. Go and be Zen in a trench in Ukraine. Then show me your Zen. If you're so Zen and you're so fantastic with your mind, any of these people, I openly challenge you, considering you're all physically incapable, Go do an MMA fight and get the shit kicked out of you. Go and you know you're gonna lose because you're a pussy. I know you're gonna lose. You know you're gonna lose. He's gonna hurt you, but you're Zen. Show me the power of your mind. Go get your ass whooped. Oh no, you're scared. You won't do that. You won't go get in the cage and get grounded and pounded. I thought you were Zen. Turns out you're only Zen when everything's fine. That's not Zen. It's not Zen to be Zen when everything's fine. So all these people with their spoiled little privileged lives and their yoga retreats. Oh, I feel so great in my yoga retreat. Oh, you feel so great, one of the most idyllic locations on the planet, eating food that's prepared for you. You feel great. Wow, mental control. Clown show. It's a clown show. If these people were truly who they want to pretend they are, they'd be in the trenches somewhere. The UFC fighter has more zen when he's getting punched in the face in front of all these people, in front of his screaming wife, worried about him losing consciousness forever. When he's taking shots to the face and still avoiding them and keeping a clear enough mind to slip the punches. So all these people are full of because if they were truly zen, they'd live a life similar to mine. But they don't. I ain't lonely. I've never been lonely. I've never been lonely. You don't know me. I've never been lonely. I had no money, and I was never lonely. And I don't think it's possible for anybody to stay in a scenario where they're truly uncomfortable. If you fall asleep on your arm, and your arm really starts to hurt, even in the deepest sleep, you're going to wake up and move your arm. If you sit there and your life has been in a rut for 7 years, you are semi-comfortable in that rut. Sure, there's days you're pissed off. Sure, you're semi-annoyed by it. But there's also days when you just play video games, eat pizza, and you're kind of cool with it, and it's no big deal. If you were truly unhappy and uncomfortable and discontent with your scenario, you wouldn't be in it. When I was broke, I couldn't sleep. Please understand me. When I was broke, I couldn't sleep. I'd be trying to go to bed thinking, these people have Ferraris. I want a Ferrari. I couldn't sleep. I just understood that there was a version of reality that I had yet to experience. I saw my parents struggle to pay the bills, and I saw my friends struggle to pay the bills, and I saw everyone around me unable to eat, and then I saw certain people with $500,000 cars, and I understood there must be a different version of reality. There must be a version of making money, a version of banking, of finance. There has to be a different world. This world I'm in, everyone's poor. This is garbage. That world, I can see people are living a reality that I can't even fathom. I'm under the mentality that you are exactly not where you deserve to be. That is one version of reality. That's one version of events. And although that's true, I want to put it in a different way. You're exactly where you wish to be in life. Even if you think you are not happy where you are, I can promise you are. Because if you're truly uncomfortable, you can't even sleep. If I put you on spikes, you can't lay down. You only lay down even if you're semi-comfortable. What I often hear from people and see from people is that they get very motivated for short periods of time. They'll be very motivated to change their life for 3 hours, and then they'll just go back to playing video games, and they're actually not unhappy with their life. They're fine to play video games and eat beans on toast and sit around in a small little apartment. They only become unhappy for a few hours now and again. That's when they talk about how motivated they are. That's when they talk about how hard they want to try. But in general, they're actually perfectly fine with their life, meaning they wish to be there. If they wished to be anywhere else, they wouldn't be doing what they're doing. And by extension, they would be exactly where they wish to be. I want you to understand at home, whether you're successful or unsuccessful, you wish to be where you are. If you wished to be big, you'd be big. You would train all day, every day. There is no such thing as wanting to be big and wishing to be big truthfully and not being big. If you say to a man, do you want to be bigger? They'll all say yes. But do they really wish for it? Oh, you'll take it for free. Or you'll take anything for free. You'll take a Toyota Corolla for free. You won't buy one. Taking something for free is very different than going out there and earning it and paying for it. They're very different things. So you're as big as you wish to be. You're as rich as you wish to be. You live where you wish to live. Because truthfully, when you wish for something with all of your heart, never...
Spending the next 1 hour watching this guy from the Humble Trader. Truth about trading bots, algorithm, future, and quants.
As many videos as you want and never have to worry about showing your face on the camera. Cartoon videos educate better, capture attention longer, and convert faster, making them one of the smartest investments you can make for your business. I'm so
It's kind of a trade secret in a way, but I'll let some of it out.
No emotion, automated,
Yeah.
faster, does what you want him to do, not second guessing itself. And
I
if
saw
you
this
have a
guy's
system,
video on
you'll
YouTube,
be in a
Sha.
very good position. That's one
While I
type
was
of deal
scrolling
you can
through
do
some
with,
shots,
proprietary
and
firm.
then
But I would get 90% of the
I think
profits.
he said
So
the thing that
90% of
shocked
the profit?
really
Oh,
caught me.
wow.
So
Imagine a trader who's traded from everywhere and has done everything.
after now,
That's
I'll watch her
Ding.
own video because
Ding is an
seeing that she started using Claude for trading too. This thing about Windows laptops, so very unreliable things. Because now tell me why the audio just went out. Father Lord.
Connected. Connected.
It's kind of a trade secret in a way, but I'll let some of it out.
No emotion,
Automated.
Yeah.
Faster. Does what you want him to do, not second guessing itself. And if you have a good system, you can be in a very good position. That's one type of deal that you can do with a proprietary firm.
Okay.
But I would get 90% of the profits. So
90% of the profits?
Sure.
Oh, wow.
Yeah.
Imagine a trader who's traded from everywhere and has done everything. That's Ding. Ding is an experienced quants trader who started his career trading for private offices and big institutions, then eventually moving to the Cayman Islands to be the managing director of a private trading firm. Ding was also the CEO of an Inc. 500 technology company. For his work, he's been nominated as the Entrepreneur of the Year by the Gulf Coast Business Review. Ding has since then transitioned from his corporate life to day trading full-time and practices what he preaches to his clients. His main priority now is to teach his kids how to trade and help them with their businesses. In today's conversation, I'm really excited to have Dean explain to you guys what quants trading is, his favorite quants trading strategies, and what it means to find a balance as a trader, a business leader, and a parent. Please welcome my friend, Dean. Welcome back to the 5th episode of Humble Traders, a podcast for active traders. I'm your host, Shay, aka the Humble Trader. If this is your first time tuning into the podcast, I interview, share stories, and trading strategies from some of the most inspiring traders from around the world. If that sounds good to you, please remember to smash the like button and subscribe to see more interviews like these in the future. Welcome to the show, Dean.
thank you so much. Thanks for having me. It's great.
Yeah, I'm so glad I met you last
I'm going to
summer
walk
when we were
in.
doing the
I'm not going to-
YouTube
I'm not going to
video.
sleep.
Yeah, that was a lot of
Yeah,
fun.
I'm going to
that was
walk
really
inside the
fun.
room so that I can listen to this and not
Like a
sleep.
great way for me to get
These are one of the
introduced
things I
to
do
the
to
local
make sure that
Vancouver traders. I had no
I-
idea so many traders
I
are
don't
here.
sleep.
Yeah, it was a great turnout.
Yeah,
Today
and then I
because I
think
eat,
you,
so that's why.
out of all the
This
traders
phone
I've
is
met
not
so
even
far,
getting hot.
you were one of
Buy
the most
better thing.
experienced, like who's been in the game for the longest, I think.
How long you been trading?
Yeah,
Okay.
about, I guess, yeah, close to 30 years would be from my first trade. But I started taking a look at what I wanted to do when I was in high school. And I knew that I was wanting to be in the sports business and sports agency and, you know, one day own a pro football team or something like that. But I also was looking at, introduced me to Forbes magazine, and they would list the 400 wealthiest people. They're cutting out what these people did and put them into industry folders. And I said to myself, once I go through university and when I'm close to finished, whatever's the fattest folder that didn't have to do with biotechnology or having to build some massive company, I would look into that one. And then after about 3 or 4 years of doing it, the biggest folders were guys who were money managers, hedge fund managers. And I said, no, and I started looking at their backgrounds and I said, no, not all these guys are, you know, rocket scientists. And this is something I'm interested in already. And I said, yeah, let's go in that direction.
Oh, okay.
Yeah.
Wow, so over 30 years. You're a true veteran.
I think so. Yeah.
You think so?
Yeah, quite some time. And then when I get out of school, a family friend who was a mentor at the time, representing athletes when I was in university, is something, you know, people worked regular jobs. I was representing athletes. And he said, well, you could probably do a lot for guys long term if you learned how to manage their money. So I went and then learned how to get it. He got me into the financial business. And then from there, I started reading about some of the best people.
If you are looking for an opportunity to own real assets and produce long-term value
in history and managing money and traders and all that sort of thing. And went down to the library, talking about being in it for a long time, and looked at the microfiche. Do you know what microfiche is?
Is that like a disc?
Nope, even before discs. So pulled out the microfiche, and it's a piece of plastic paper, and you fed into this machine that looked like an overhead. And it would bring out. So I'm looking at all these articles on a guy by the name of Warren Buffett. So I started reading about him, and then I go, wow, at the time I was in Toronto, and I heard about this guy named Michael Lee Chin, who was doing a lot of these things like Warren Buffett, and he had a small firm. So it took over the next couple of months and tried to get in and started studying value investing at that firm under him. And I did that for a couple of years, and then had a really interesting experience, and then was part of starting another firm that grew really well. It ended up having over 700 reps across the country, over 10 billion in assets. I was one of the original guys that started there, but I left early to go out on my own and start learning more and more about trading. My knowledge base started really going towards more sort of trading and doing that than managing money in mutual funds.
Oh, so you started out more so research, kind of like fundamentals, value investing.
Yes.
You moved on to trading.
Yes.
Why? Why do you think you instead of staying in that path, you started to get interested in actually trading more actively?
So I met a lot of these money managers, and as they were talking about individual names of stocks, and this stock went from here to here. And I was kind of dismayed in a way that the overall funds were making 10, 12, 14%. Yet these individual names, if you would have a more concentrated portfolio or names that you were buying and selling, you could get way outsized returns. So I wanted to really move towards that rather than being involved in regular returns.
Oh, I see.
Yeah, so I wanted a bigger upside, and I wanted to do, like I was reading about these guys that I had read years before in Forbes magazine.
Okay, so that's how you got into trading.
Yeah.
Then specifically, how did you get into quant trading?
So I was consulting to a bunch of different companies all over the world, mutual fund companies, some hedge funds. I was sitting on the board of a couple of hedge funds as well. And I got to meet different money managers in that genre. And some of the people that I met were running a quant fund. And I started, and actually we were out to dinner one night and they were saying, oh, we heard that you had a pretty good year. Another guy said, oh, you had a good year. It was the end of the year, like late December. And the one guy said that, yeah, we had a pretty good year. We were up like 281. And I thought they had made $281 million, but actually more than that, but they were up 281% for the year.
Oh, wow.
And I went, and you guys do quant stuff, I got to learn more about that. And as luck would have it, I got recruited by this company to consult to them. And then I was offered to be president and CEO. And it was a, 'systematic computer-generated trading software that they were selling to the public and to institutions, and they wanted me to come in and help them reorganize the company, re-engineer it, which I did, and then I took it over as president and CEO. And I had 8 full-time engineers, computer scientists, and that gave me the opportunity to look all around the world and hire brilliant people to come in and try to make our trading systems better.
Oh, okay.
Yeah, so I learned a ton from there, and then we grew that business. I'm fortunate to, it was named the 55th fastest growing company in America the year after I started, and once again the next year in the top 150 fastest growing companies in the country. And we started an internal fund, and these guys were in. We had meetings every week, so my knowledge base in that area went through the roof pretty quickly. Then I left there and then started up consulting to medium to large size firms in the States, and then became director of quant research at about 1,000 member brokerage in the States as well. And doing all of that and consulting while I was doing that as well got me introduced to a lot of different programmers, mathematicians from all over the world, and that helped my knowledge base go up and up.
Yeah, when I think of quant trading, I think of a lot of math, numbers, like flying on the screen, a lot of programming. Is that accurate? Or like that's
Yes, like some
public's perception of
Yes,
quant trading?
absolutely. And I think at first, most of the people's perception was HFT, that high frequency trading,
Yeah.
going off like crazy and everything. That book, Flash Boys by Michael Lewis, was one that really brought it to the forefront. And but the way that I look at quant trading, too, if I say dummy it down, is
Yes, please do.
yeah. So you're using algorithms, and an algorithm is simply an if-then statement. All the
Okay.
engineers out there and that sort of thing, I apologize if making this easier, right? But the way I look at it, you're using an if-then statement, and it could be numbers and it could be words,
Okay.
and you're programming a computer to do the entries and exits how you want the computer to do that.
Okay.
So you tell it what to do, and it does it on an automated basis. And if you're really good at putting in excellent algorithms and rules, it's basically rules-based if-then statements. So if you have a good strategy, then you will create profits. If you don't have a good strategy, you will create losses. It's the easiest way to put it.
So you kind of pile, let's say, a bunch of rules, 10 rules, for example, and a quant trader will turn that into a strategy that will automate the trading
Yes.
based on those 10 rules or
Yeah.
more.
So think about when you're looking at a chart, a price chart. There's patterns, and there's identifiable patterns. I can identify it and say,
$200 till I need. When you sit at your desk, you're not thinking about the chart. You're thinking about your future.
I can't just do my laptop and say, hey, I follow the process, don't have money. This is not a hobby, Alice. It's everything.
This trade has a 40% chance of being a loss. And that's perfectly okay.
Why would I want to be okay with a loss? I want to win.
Did you win?
Win big in the Middletex that win promo.
Yeah, those
Yes,
good though.
6 brand new cars.
I don't know what
Along
you're
with
doing.
billions in airtime.
buy here, sell there. Now, I hire programmers to program in when the price goes to this, and when the price goes to here, sell. And say, well, how do you know what to do, right? So you have to have good information in. So to do that, I use statistics and probabilities. So statistics being, all we do is we take, let's say, the movement of a stock. Let's call it the Qs, the ETF that follows the Nat 100. So we would take a look, going back, say, for example, 100 days, and we would track the movement of the Qs over the last 100 days, intraday, end of day, and we would get to know what the pattern is. And then we would try to identify if there's repeating identifiable patterns that we can then put in a buy, a sell, short, a buy to cover, and continue to do that over and over. And when you have something like that, you have a winning system. And then why reduce it down to code And why do it like that? Because no emotion, automated,
Yeah.
faster, does what you want it to do, not second guessing itself. And if you have a good system, you can be in a very good position.
Oh, I see.
Yeah.
So if a quant trader does that, that means does he still have to monitor the positions at all? Or
Yeah,
he-
for sure. Like, I don't know anybody that puts it on and leaves. Like, you hear a lot of stuff with YouTube. Just put it on, set it, and forget it.
So that's not true.
That's not true.
Ah.
Well, maybe they are, but I don't think they're making the money that they're saying that they are.
I see.
Right? So there's a gentleman, a firm called Renaissance Technologies that I was introduced to over 20 years ago.
Okay.
About 25 years ago. And these guys were some of the most sophisticated mathematicians on earth. Mathematicians, code breakers from and they created this company to use quantitative systems to trade both all kinds of different instruments in the market, futures, commodities, stocks, and their returns were outstanding. So, like, to the point where for what's been published, their long-term returns over 30 years is above 60% annually.
Wow.
So you're doubling your money almost every year.
Yeah.
And it's been reported these guys are some of the wealthiest people on earth. So one of the things I learned when I was young, emulate and duplicate, and then see if you can make it your own. And if you like winning, then, well, that's a good target to go after. And so that's really how I use that as a target. I wanted to go after that, but I didn't want to be involved in large companies.
I see.
Yeah, so hence the being an individual operator.
Oh, because you were involved in larger companies and you kind of decided to take a step back and do your own thing, do your own trading.
Yeah, so I was president and CEO of a company. We had 150 employees, and then another company we had about 200 employees. And I said, you know what, I find it more interesting to have a small company, especially with lifestyle. So as I was maturing, I had done so much work. I started working when I was 14 years old, right? And I'd work like crazy. And I said, you know what? Can we work smarter? This is not rocket science. Work smarter, high profitability, lifestyle, freedom, that sort of thing. And everything really ties itself into if you can get a good trading system and trading complex going. I think it's one of the best things you can do.
As you probably already know from all my YouTube videos, most of my strategies involve scalping, momentum, and trading. All of those things will require a very fast broker platform. And I have an exciting promo from one of the premium brokers I personally use, Centerpoint Securities. If you're trading with over $30,000, you can use Centerpoint to day trade with 0 commissions for 60 days. And that's not all. You'll also get access to Dash Trader Pro for 1 month for free. That's the trading platform you see in all my videos. That's another $150 value for free. To get this offer with all the freebies I just mentioned, you can sign up to Centerpoint Securities down below. And now let's get back to the video.
Yeah.
So how old were you? Do you remember how old were you when you kind of took a step back and just go all in on your own?
I would say I was a bit of a late bloomer because I wanted to get really good at this stuff and I wanted to have the feathers in my cap. So I wanted to work on Wall Street. I wanted to work on or near Bay Street, on or near Wall Street. I wanted to be involved in companies. I wanted to be involved with the hedge fund. So once I had got all those things done and I had run a research company and a consulting firm, as luck would have it, some family situations changed. And I decided to pivot and said, okay, no more consulting, no more selling research, no more doing this. I'm going to go all in and I'm going to start and bring in my own research and develop everything internally, not sell anything externally, and start trading on my own. Not just for my own account, but also I started doing something that I call Fund of Ones.
Fund of Ones?
Fund of Ones. So, yeah.
Hi, my name is Bruni Breezy, creative coder and a fan of rock music. I work with big agencies, small...
O-N. So FO1. So Fund of One. So basically, instead of just starting where a lot of people start, they save up a little bit of money and they start trading their own capital, and they grow it and they grow it and they go from there. And a lot of times to get to, to an exceptional amount of income or money, you have to save for a long time. It takes a long time.
To get that capital.
Yeah, you can use leverage or whatever. So what I did was I was once again fortunate enough to meet some people, and we started a individual fund, but only one person, well, two people in the fund, myself and another person. And then I did it with another person. We started another fund, and at one point I had about 4 different funds going with a couple different families. And then I also did deals with institutional proprietary trading firms. So I was trading proprietary money for firms as an individual trader, but doing on my own, off-site, from the tropics.
Oh, so okay, let me break it down a little bit. So it's the family office money,
Yes.
and you go in as trader who trade for them with their capital.
Yeah, and I don't actually go in and do it. I do it on my terms and my place and where I want. So a lot of times that people are saying, oh, you see on YouTube and that sort of thing. I see a lot of people on Instagram saying, oh, I'm down in the tropics trading from a beach with a, you can't even see you can hardly see a screen in the sun.
I always wondered, I'm like, how do you actually trade on the beach?
Yeah.
The reflection itself is just
Yeah.
the internet connection, the reflection, like there's no way.
Yeah, there's so much to actually do it. And there are a lot of people that are doing it from Bermuda and Grand Cayman, Bahamas, that sort of thing. So what I did was I set up an individual fund with a family office, which is basically it's a fancy name for a private family that has a fair amount of money that wants to manage their own or hire somebody to manage their money for them.
Oh, I see.
So I was just one piece of their complex where they would do their management or have their in-house people. I was an outside person, and I would do a deal with them where
But you're the trader.
I was a trader, and then it's not like, oh, this is long-term, we're trying to hold positions for 3 years. No, my turnover was daily, and we'd do anywhere.
Daily. So they were day trading at that point.
Yeah, absolutely. Anywhere from one trade to hundreds of trades a day.
Oh.
Absolutely, yeah.
So I'm just curious. I don't know if you can share. So if it's their money and you trade for them, what's like a profit split like?
The profit split, you can usually in those, well, not usually, but what I was experiencing doing was pretty fair. We can go 50-50. So, and then from an institutional proprietary trading firm, usually what they want you to do is they want you to put up what's called first risk capital. So I would put up our own capital. Let's say for argument's sake, I'd put up $100,000.
Okay.
They would give a couple $1 million to trade against that. My $100,000 would be at risk.
I see.
So one type of deal that you can do with a proprietary firm.
Okay.
But I would get 90% of the profits, and I would use their money.
If you want to learn how to edit really well from professional Hollywood editors, we're going to show you the stuff that nobody else is teaching. I'm talking about real creative skills, like how you can use music and sound design to make a joke funny. How to use cross-cutting to control the tension. You're going to learn about feature editing, trailer editing, action editing, pacing out drama, layering sound design, and how to organize it all in your timeline so it's easier to work with. Hey, I'm Chris, lead trainer at Film Editing Pro, and I've spent the last 15 years working in Hollywood, most of that time at Universal Pictures. For almost a decade, our courses have been used by editors working at major studios like Disney, Universal, Warner Brothers, Blizzard, Electronic Arts, and HBO. Huge businesses like Red Bull and the UFC. Massive YouTube channels like Linus Tech Tips, and agencies all around Hollywood cutting the trailers for some of your favorite movies. We trained a lot of editors. Recently, we put together a short course with 14 of our most popular lessons across all topics. This is going to be your starting point for training with us. Click the ad, and I'll show you what I mean.
So
90% of the profits?
Sure.
Oh, wow.
Yeah, because my money's at risk. You have
That's true.
You have no risk.
Your money's at risk first. The first 100K.
Is my risk.
Oh,
yeah,
I see.
Or our risk if I were or something like that.
Oh, okay.
So then the next type of proprietary trading firm is you come in and you become a member of their limited partnership.
Okay.
And they give you access to their capital. And those ones go anywhere from 30%, 40%, 50, 60, 70% payout, depending on how good you are and how consistent you are. So I did my homework, and I was lucky enough to get with a couple of really good firms for a good period of years.
Oh.
Yeah.
And when you were doing that for, I think, a couple of years, you said you were doing that in the tropics?
Yeah.
Where is that?
Yeah, so I lived in between Miami and also Grand Cayman.
Oh.
And I lived in the Gulf Coast as well.
Uh-huh.
But my family's up in Toronto, so we'd spend our summers in Toronto and Whistler.
Uh-huh.
And in the winters, where would you want to be? In the tropics.
Yeah,
So
okay.
I was located for several years out of Grand Cayman in the Cayman
Oh.
Islands. And I've also worked in other locations when we want to live there.
Mm.
So when I decided to go all in and do that type of trading, I also said, okay, now's the time. With my children at the time, my girls I've got twin girls that at the time were 10 years old, 11 years old, and I decided, let's move every couple of years, give them a global education.
Oh, wow.
And let's move around the world. I can do this,
Mhm.
and as long as you're consistent, and as long as you continue with a good track record, then you can do it. It's not as easy as what people say. There's all kinds
Travel
of
from
things.
anywhere.
Travel, yeah.
Travel and trade from
Yeah.
anywhere.
So yeah, like my Instagram is trade.from.anywhere.
Uh-huh.
It's just basically that's what we always talk about.
Mm.
And you have to be a good trader first.
Yeah,
Then you
of
have to have
course.
the capital second. And then there's all kinds of things you have to do with that, like visas and regulations. And are you going to get a place are you live in a hotel? Get a suite in a hotel and live there. Kids have to go to school.
Yeah.
So with my kids, they did a little bit of brick and mortar school, and they also did online school. So we could travel and do
Okay.
different things, and they could pursue their passions. So
Wow.
at the time too, it was just me and my kids.
Yeah.
And so really my most important single output measure as a man is how good of a father can I be.
Mm.
So that was number one. How good
Right.
of a father, and then how good of a friend, and all that can I be.
Mhm.
But that's first and foremost most important. So can we do this? And if we can, what do we want to do? So I'm a big believer in writing the script and rewriting the script every couple of years if you need to. So like on the first year plan every couple of years, right?
I see.
And so decided, okay, I want to live in the tropics, and I want to educate the kids. I want to live on an island. I want to live on a beach in a different part, a surfing town. We wanted to live in the cities. We wanted to travel when we could. So we traveled most summers all over the place. And every place that we lived and traveled to, I traded. So when we were in Rome for a couple of weeks, or in Italy, traveling in Italy, I traded pretty much every day.
Oh,
And,
wow.
Yeah, so you have to do that. I got really good at trading on my phone with a phone app.
You actually trade on the phone?
Absolutely, yeah. And then with the times, we would have to go back to the hotel when we were in Rome to trade, look at them up, and do some trades that were happening. And everywhere from I've traded from planes, trains, cars,
Boats? Not yet.
Yes, absolutely, boats. I've traded from boats. So
Do you
I
have
was
good
thinking,
internet on the boat?
yes, absolutely.
Wow.
I've traded from Hawaii, traded from Rome, traded from Toronto,
Okay.
all over the place, all over the world.
At this point, when you're trading with your two kids and traveling, are you still managing the funds, or are you trading your own capital?
So in the funds, part of the deal with that was I had I might have had some money in there with them as well.
Oh, I
usually
see.
have eat my own pudding and put it in a wallet.
That's good.
So it is
Yeah.
a fund with only one person. So I call it a fund of one, but it's really just a partnership between me and another person.
So
to
you
do
also
it.
have your own money in
Yeah,
there. Oh,
yeah.
I see.
And absolutely. So I'd be trading my own capital, which is it's just commingled with theirs.
Okay.
It's just a fair way. Like if I'm gonna ask you to eat this food along with me, I may as well eat it as well, right?
Oh.
Yeah. So
Gotcha.
as more Buffett said, we eat our own pudding.
As you can see from my conversation with Dean, quant trading and automated trading is definitely getting more and more popular. Is that a topic that interests you? Let me know if you want to see more. You can comment quant trading down below.
It takes is one slug, and the vibe changes completely. Maybe you like it spicy, or keeping it fresh, or you're just here for the food. Feast the fun with Mini Me Noodles.
Behind every success story is a place that helped make it possible. A classroom, a children's home, a community center, a safe space where someone was given a chance to dream.
Here's the room. This is a basic kitchen.
These places often change lives without recognition until now.
Welcome to Make Life.
Inspired achievers return to the communities that helped shape their journey, the places that stood behind them, the people who believed in them. Now it's their turn to give something back.
We're doing it for those children.
There will be pressure. Give me 24 hours. There will be obstacles, and there will be moments where the clock feels impossible to beat.
In 24 hours.
But this isn't just about renovating a room. It's about restoring pride, creating opportunity, and reminding people that they matter. This is Make Life Good.
So at this point, are all your strategies automated?
At this point, like before or like right now? They've been automated for years.
Oh, okay.
Yeah. So recently, like before, I had to go and hire programmers. So if we can go back 20 years, I was getting in touch with programmers and mathematicians from different top universities in the States.
Okay.
And they would know somebody, and I would get together with them, either bring them into where I was living at the time or meet them somewhere to go over their credentials and try to get them to help build something. So recently I discovered this company called Shark Indicators.
Okay.
Now they make a piece of software. They have two pieces to the software. One is called Bloodhound, the other one's called Blackbird. Don't know why they're called that, but good for them. But the important thing is the Bloodhound piece of software. It allows you to test your theories, test your strategies. So let's say everybody has like a strategy that they want to follow in the markets or that they do in the markets. So let's say buy the S&P mini above when the price closed above the 100 period moving average.
Okay.
Hold that instrument for 20 points or 1%. When it goes up 20 points or 1%, sell. So, and let's say we do the opposite for when it goes down. It goes down and we want to short it.
Okay.
Okay. So, if the price of the S&P closes below the 100 period moving average, then sell it short on close and hold that position for a 20-point profit.
Okay.
You can put that in, and let's say you follow any type of indicator you can think of, or any type of number rule you can think of. If you can think of the rule, by just clicking the button, to know programming, you don't have to be a programmer. You can put that in. It took me about an hour and a half to learn it. That was it. Yeah. And so something that would have taken me a couple $1,000 and hiring a programmer to do a couple years ago, now I took lessons on it for about an hour, 2 hours, and I'm off to the races creating strategies that work just like other quant strategies that I had built by software programmers. The other part of the software is an advanced trade management system. So if you wanted to buy for you, sell for you, put in a trailing stop, it'll trail for you, put in a hard stop, and you can be as sophisticated as you want or as unsophisticated, just put in simple stops. But this, I think, software is revolutionary if you learn how to use it. And it's for individual traders. The thing is that it works for NinjaTrader, which is a software platform that a lot of futures traders use. It's all over the world. So.